Hello and welcome to Inside ETFs. I'm Ramzan Karmali. Today we're looking at small cap ETFs and my guest is Ryan Jackson, Manager Research Analyst at Morningstar. Small cap stocks have underperformed this year as stickier inflation has led to fading expectations for rate cuts. Small firms often rely on more debt and are usually heavily reliant on consumer spending, which tends to slow when interest rates are high. The main index for small cap stocks, the Russell 2000, is pretty much flat in 2024, while the S&P 500 is up around 15% in comparison. But with the chances of a rate cut in September rising to around 60%, could this trigger a turnaround for small cap ETFs? Well, to help answer that and more, I'm joined by Ryan Jackson from Morningstar. Ryan, thanks so much for joining us. So let's start with that thought. Is it as simple as saying as soon as the Fed starts to cut rates, these small cap ETFs will start to perform?
Yeah, I mean, that's certainly a big part of it, and certainly what we've seen, in sort of this rate raising cycle over the past two-ish years. But there are more factors at play here. You look at some of the headwinds that small caps have been facing. On one hand, it can be as simple as they just haven't owned the handful of mega cap technology names that have driven an outsized share of the global market over the past few years. And I think it's no secret that you're not going to be finding those types of stocks in small cap portfolios anytime soon. So that's a challenge. Another one that we've seen is sort of this trend for companies to stay private for longer is a little bit of a structural challenge for small caps. You think about how small cap indexes are designed to work. They're effectively buying companies when they have a very small market cap, hopefully kind of riding that ramp as they generate strong performance, and then selling them into a mid-cap index or a different portfolio when they grow a little bit too large, hopefully after they've generated a really nice profit at that point. Now, if companies are staying private and jumping into the market, say as a mid-cap or a large-cap stock, that's a huge part of the ramp that small-cap portfolios just aren't able to access. So we'll see whether that keeps up. There are certainly tailwinds at its back that we can get into as well. But along with rates, there are some challenges that small caps will have to continue to navigate.
Now, the two biggest ETF funds out there in the small cap environment are the iShares Core S&P Small Cap ETF, IJR, and the iShares Russell 2000 ETF, IWM. Both of them have performed pretty flat this year, but is there any noticeable difference between them apart from that?
Sure, they tend to play a similar role in investors' portfolios in that they're kind of your traditional plain Jane index fund in the small cap space. There are some meaningful differences between the two, though, and we tend to have a higher rating on IJR, the S&P Small Cap 600 Index ETF, because it does a couple of things really well. And number one, it manages its turnover a bit better than the Russell 2000. That becomes more important in the small cap space when you're faced with heavier trading costs because those stocks aren't quite as liquid. So by virtue of its stronger turnover buffers, it's going to be a little bit more of a cost-efficient proposition. And number two, I mentioned earlier the importance of quality in the small cap space. The S&P index has actually come with a profitability screen. So right away, they're turning away at the door any of those really kind of junky, low quality small caps that could kind of weigh on the portfolio. Oftentimes those trickle into the Russell 2000 and can be a little bit of an anchor on its returns. So these are very marginal differences. They generally are going to perform quite similarly. But the S&P index and IJR, the fund that tracks it, kind of has some of those benefits around the margin that tend to make it a better long-term play.
And in terms of investing in ETFs, should you look for the more actively managed ETF, something like the Avantis US Small Cap ETF, AVUV, or stick to the traditional IWMs and the IJRs?
Sure. I think first and foremost, you want to keep out for ETFs that are doing a good job managing expenses. That's as predictable as it comes. When it comes to foretelling performance, you want to keep those down, and diversification is another thing that's very important. So that's good principles for just fund selection in general. Small caps are definitely no exception there. When it comes to the active-passive decision, we have seen long-term active management has a little bit more of a leg up in the small cap space than they do in large cap. The idea here is these companies aren't quite as efficiently priced. There's not as many eyeballs on them. So there's more opportunity for active managers to really add value. So along those lines, along with low fees, diversification, and quality, we do look at a couple of Avantis ETFs as such a couple strong plays in the space. Avantis US Small Cap Value ETF, ticker is AVUV, and Avantis International Small Cap Value, AVDV, are a couple great options that are active but systematic, so they're governed by a blueprint that really dictates how the portfolio is put together, but they're going after some of the cheapest and highest quality names in the small cap space. That's a really attractive combination because you're getting that high quality orientation without paying too much for it. We've seen that play out with really stellar performance for both those ETFs over their few years on the market.
Now, if you're an investor who's solely been looking at large caps, looking at the S&P 500, is now the right time to consider a small cap ETF?
I think there's always a case to be made that it has a place in your portfolio just in the name of diversification. But if you were to make the argument for now being the time, it would really be a valuation story, right? So I mentioned the gap between price to earnings ratio. You look at the Morningstar Global Markets large cap index compared to that small cap index, and at the end of May, the gap between the two was wider than 93% of all months over the past 20 years. Now, price to earnings isn't a perfect predictor. That's not a one-trick pony when it comes to picking a fund, but that is a pretty good indication that there's a lot of room for small caps to run. There's really nice growth opportunity there, and the valuations aren't going to get much more attractive, at least relative to the large caps, than what we're seeing right now.
Ryan Jackson from Morningstar, many thanks for your thoughts. And that is your look at small cap ETFs. I'm Ramzan Karmali, and this is Reuters.